Well, thanks for tuning into Worldview. I'm your host, Neer Shah, and on the show today, we have with us Dr. Edward Yardeni. He needs no introduction. It'd be lovely to understand from him how does he see risk assets from his prism now that some time has passed between the last time that he said that he feared a melt up as opposed to a meltdown. Dr. Yardeni, thank you so much for taking the time out.
Thank you.
I would love to understand a lot of some bit of water, a lot of water has flown under the bridge between the time you made that comment about expecting a melt up to now. How do you view risk assets or investment grade assets in general from your prism currently?
Well, it certainly feels as though over the past few years, we've had a couple of melt ups and meltdowns. It's been a real roller coaster ride for sure. And, coming into last year's bear market, we had a melt up that was led by the mega cap 8 is the way I like to call them. Some people call them the Magnificent Seven. Then we had the meltdown. It really was a bear market, but it didn't really last that long, and it wasn't that severe. I mean, in some sectors like technology, it was terrible. But then we had another melt up that basically started on October 12th of 2022, again led by the mega cap 8. And I was thinking that the S&P 500 would get to 4,600 by the end of this year, which was basically a melt-up forecast simply because I was the most optimistic about where the market could go. There was, as you know, a lot of pessimism about the market early in the year, and we got there by July 31st, so I wasn't optimistic enough. And when we got to 4,600 at the end of July, I concluded maybe that's it for a while, and maybe the market will go down for a while, up for a while, but we may very well end up at 4,600 again. But I don't know if you call it a melt up, but I have the high forecast for next year of 5,400. So I think for the S&P 500, for stocks generally, risk assets, I think the environment will remain positive. But as we can see, there's a lot of volatility. There's a lot of reasons to be worried. And I am very aware of those reasons, and I'm constantly analyzing them and trying to conclude whether optimism is not the right way to have an approach to the market. But, stocks over time tend to go up, and risk assets, particularly stocks, do well. Bonds have become risk assets, and I think 4.5% to 5% for U.S. Treasury bonds is actually pretty attractive.
Yeah, is there, have you moved from there is no alternative or Tina to there are reasonable alternatives because you get, dollar terms,
Yes.
7%. And is
Right.
that a bit of a ceiling to the
Yeah.
quantum that stocks can go up to or buy?
Well, it could be, but the stock market really has changed pretty dramatically. We've got now 27% of the market capitalization of the S&P 500 is in these mega cap 8, and they are highly prized. They're very highly valued. They have valuation multiples of almost 30. And that, of course, because they're so large in the market, that drives up the valuation multiple of the S&P 500. Without them right now, we'd probably be around 15 using forward earnings. With them, we're more like at 18. So they're having a dramatic impact on the market. And it's interesting that they've actually performed pretty well, surprisingly well, in the face of rising bond yields. And it may very well be that investors are once again finding that they are special. And what's special about them is they actually aren't that exposed to higher interest rates because they don't have that much debt. They generate a tremendous amount of cash flow. They're sitting on a lot of cash and earning a good return on them. So we have to be very flexible when we analyze the markets. History repeats itself sometimes, but and sometimes it rhymes, and sometimes things are different. So I understand what you're saying, and it's perfectly valid to say that there's more of a hurdle now in terms of an alternative in the bond market. But there's a lot of wealth in the world, and wealth needs to be invested somewhere and needs to be diversified. And people don't just put all their money in the bond market. And now the bonds have turned out to be a fairly risky asset, so they may actually view stocks as actually not that risky relative to bonds.
Yeah, well, certainly wealth destruction in the bond side for sure. Just
Yeah,
wondering, this higher for longer, Dr. Yardeni,
yeah.
does it mean that EMs at large will be relatively less attractive until rates turn?
Well, the interesting thing about higher for longer is it's widely viewed as a negative, implying that inflation is going to stay higher for longer, and therefore the Fed is going to have to keep interest rates higher for longer. But the way I look at it, maybe it's because I tend to be an optimist about things. I try to be realistic, but these days, being an optimist is a contrarian view, as you know. Maybe it's been that way for a while. But my view is higher for longer also means that the economy is actually doing pretty well. The U.S. economy before the great financial crisis, we had this new abnormal period between the great financial crisis and the great virus crisis, where the Federal Reserve and other central banks were trying to raise inflation to 2%. They were lowering interest rates to historical lows. We're actually back to yields where they were, to interest rates where they were before this period, before the great financial crisis, 2003, 2007. The 10-year bond yield was 4.5% to 5%, which is where it is right now. And the economy was able to withstand that kind of level, and it's doing it again. So higher for longer has a positive implication that the economy may actually be resilient. We've recently gotten some strong employment numbers, and I wrote a piece called "Consumers Hotter for Longer." Remember, at the beginning of the year, there was a lot of recession talk. I wasn't in that camp. So the other part of it is, I think inflation is turning out to be transitory, and I think higher for longer may not be the case. That we may see, in fact, 4 federal funds rate cuts next year instead of the 2 that the Fed now is talking about. So things can change, and I think what will change is, I think there'll be a perception that inflation really isn't as much of a problem as we thought. And meanwhile, the economy is doing well. And I think the big surprise in the U.S., at least, is going to be a return of productivity growth, because we need it to offset the shortage of labor.
Interesting. I presume you write some of this stuff on your website. Yardeni Quick Takes is where we can read more of this.
Yeah, well, we actually designed a research product for individual investors. Most of our client base is institutional investors, but we've had a lot of requests to reach out to individual investors, and so we've got something called Yardeni, Yardeni, YardeniQuickTakes.com. So that's www.YardeniQuickTakes.com. And it's a quick take every single day, almost every single day. I usually take one day off. And we analyze the economic indicators and how they affect the market. So it shows the relationship between the macro and the macro of the economy, global, and the micro of investing in stocks and bonds.
Okay. Well, that's some food for thought, and well, a place where maybe even I can go and try and pick up some intelligence. Now, I would
Sure.
love to get some more of that on the show, Dr. Yardeni, and try and correlate what your view around rates, which you said, who knows, there might be a possibility of more cuts, and
Yeah.
what would that mean for emerging markets like India?
Yeah. Well, India really stands out these days in among emerging markets. China's doing poorly. For several years, global investors invested, maybe even overinvested in China. But China's economy has slowed. I think it's a structural problem they have with the property bubble bursting in China, and that's depressing their economy. And at the same time, the legacy of their one-child policy is terrible. Their population is aging very quickly, and as a result of that, that also is combining to slow their economy down. I mean, they've been very successful in building state-of-the-art infrastructure, beautiful roads, high-speed trains, tremendous airports, but older people don't travel that much, and they don't spend as much as younger people. For one thing, they don't know how long they're going to live, and they don't know what their health is going to be like. And China doesn't have the kind of social safety net that other countries have. And of course, there's the geopolitical tensions between China and the West. It's not just the U.S., it's the West. And so that and the supply chain disruptions during the pandemic have made China a very unreliable place to put all your manufacturing facilities. So people are certainly looking at India, moving to India for alternative ways to invest in manufacturing and other areas. India still has a ways to go in infrastructure spending, but I think the government knows that and is working on that. So that's a big positive. But when I look around the world, India again stands out as a winner. Now, India obviously is going to be affected by the price of oil. It's been volatile of late. I don't think the price of oil is going to soar to 100 to 120. The Saudis would like to see it at 100, but I don't think it's going to sustainably be there because I don't think U.S. consumers will tolerate that kind of a gasoline price. And we've seen recently gasoline consumption in the U.S. has come down. So when I look at the emerging markets, there are interesting places like Vietnam, Indonesia, Malaysia, in Asia. But again, India stands out in Asia. In Latin America, Brazil tends to be a play on commodities, and Brazil is very dependent on China's economy. And that if it's China's economy is going to be weak, Brazil does not look like a overweight in emerging market portfolios. Africa looks very interesting because they like India, they have a young population. In some parts of Africa, many parts of Africa, English is spoken, so that seems to be an important language these days for doing business. So put it all together, and there are certainly opportunities in the global economy. My preference from a global perspective is to overweight the United States among developed nations and to overweight India in terms of emerging nations.
Well, that's music to the ears and good to know. The question is, we hear from a lot of global brokerages or brokerages which cater to global clients that there is a lot of money or investor wealth sitting on the sidelines, has
Yeah.
made applications for making an investment into India, but the starting point of high valuations seems to be a hindrance. I would love to understand, because you've looked at so many cycles, can expensive valuations in a market which is sought out and showing growth in an otherwise in a world which is otherwise not showing growth, can
Yeah.
starting valuations as a concern be overridden because of the fanfare around a market?
Yeah. Well, look, in a world where growth is challenged, I mean, nobody's really looking for a global economic boom. The IMF is downgrading its outlook, and that's because China's prospects don't look particularly exciting. Europe also has a rapidly aging population. It has mismanaged the transition from dirty to clean energy. It's got the geopolitical problems. So nobody's looking for the global economy to do all that well. Still going to grow, but it's going to be a slow growing economy. Meanwhile, the U.S. looks like it's doing fine. But that actually means that growth stocks are going to be rare in the stock market. And usually growth stocks are supposed to not do well when interest rates are going up, not do well when valuations are relatively high. But I think the reason their valuation is high is because, again, there's different kinds of growth stocks. Growth companies that don't have a lot of debt in this world are going to be highly valued. And they're going to be highly valued also because they are growth stocks and able to find revenue growth and earnings growth. So I think they may continue to outperform. That doesn't mean that there aren't opportunities in value. I think energy stands out still as an area for overweighting, simply because, again, the transition from dirty to clean energy is turning out to be very difficult. It's not like suddenly we're going to stop using oil. However, the world is moving towards electric vehicles, and that's going to reduce the demand for gasoline. We're still going to need to generate electricity to operate them. But the oil companies have concluded, well, maybe they can cut back on their capital spending and just sell what they are able to, that they have already at a high price because there's still a demand. And so they're generating a lot of cash, which they're using to pay dividends and to buy back shares. So I think energy stocks still are going to work. Financials, I think some of the bigger financials are actually growth stocks. Let me just kind of put kind of a conclusion on this particular subject, and that is, I think that all companies in the future have to become technology companies, not in the sense that they have to make or produce hardware and software. They have to use it in order to remain competitive. And technology companies tend to have higher multiples. So even financials, I think we need to think of them as fintech, as financial technology companies. Healthcare is technology, and so on.
Okay, point well taken. My final question, and that is around geopolitics. If Russia-Ukraine wasn't enough, we have one more Middle Eastern conflict going on right
Yes,
now.
terrible.
What repercussions does such a thing have, or such a period have?
Yeah. Well, I've been doing this for a while. I've been doing it for over 40 years. And there have been lots of geopolitical crises. There have been some horrible regional wars. Fortunately, there haven't been any wars like World War I or World War II. You definitely don't want to invest in stocks in a world war. But we've seen that in the past, the geopolitical crises, as long as they're not of a disastrous, catastrophic scale, geopolitical crises have turned out to be buying opportunities. I mean, the war in Europe is horrible. And it certainly has it's the most serious war that has been occurred in Europe since World War II, and now it looks like this recent war between the Hamas and Israel. That looks like it's not going to be the kind that suddenly leads to a ceasefire and life goes on. It looks like it's going to have all sorts of geopolitical consequences. But so far, it doesn't look like it's spreading to the whole region. If it were to spread to Iran and Saudi Arabia and start to affect oil supplies, that would be a real serious problem, because all recessions in the past have really been associated with higher interest rates or higher oil prices. So again, I don't like saying that terrible geopolitical crises are buying opportunities for stocks. I don't like the idea of making money when people are suffering in some place of the world, but that happens to be the reality. And so what's interesting is so far we really haven't seen much of a reaction in global stock markets, other than in the Middle East, to the crisis in the Middle East. And again, that suggests that investors have concluded that geopolitical crises, as long as they're contained, are not reasons to get out of the stock market.
Okay. So far so good. Let's see if that changes.
So far so good.
So far so good. Dr. Yardeni, such a pleasure talking to you. Thank you for taking the time out and speaking to us. And looking forward to talk to you more often, sir.
My pleasure indeed. Thank you.
Thank you.
Bye.